On behalf of both Katz, I would like to invite the members of the next panel that that is called Sovereign Funds Award in Transformation. So, the professor of Maastricht University from Netherlands and the main researcher of the European Sovereign Wealth Funds, Aaron Dixon. We would like to invite the strategy of sovereign wealth funds, Victoria Barbary. And for this session, I'll pass the floor and the work to our moderator, Paul Katz. Well, now I will switch to English. It's a very awaited moment in these 2 last days.
Across the world for their work on sovereign wealth funds. So I'm going to briefly introduce them, and then the suggestion was that we could conduct this session really as a discussion. So rather than formal speeches, we'll kind of do a series of questions, and we'd really love to have your participation in this as well. So we'll be pausing for questions from the audience at various points throughout, and please do let us know if you'd like to jump in with a question. Just as a reminder, we do have simultaneous translation into Portuguese, which is really very exciting. So if you're listening to me right now without headphones and wishing that it were a little easier to understand, we have headphones out in the hall. So without further ado, I have the great honor of introducing our 2 discussants today on this panel. First is Adam Dixon. Adam Dixon is Associate Professor of Globalization and Development at Maastricht University, and also the lead of the Globalization, Transnationalism, and Development Research Program there. He's the principal investigator of the SWFsEUROPE project, funded by a generous grant from the European Research Council. The project is focused on explaining how sovereign wealth funds are made legitimate as state actors in global and European financial markets, and how these funds are being used to legitimize and facilitate state intervention in economic development in countries across the income spectrum. From February, he will be the Adam Smith Chair in Sustainable Capitalism at the Edinburgh Business School. He has been working on the topic of sovereign wealth funds for more than 15 years and has published numerous books on the topic, including recently the book Sovereign Wealth Funds Between the State and Markets, published by Agenda Publishing. So please join me in welcoming Adam today. We are also honored to have with us today Victoria Barbary. She is the Director of Strategy and Communications at the International Forum of Sovereign Wealth Funds, a global network of sovereign wealth funds with members from almost 40 countries. In her role, Victoria works with the International Forum of Sovereign Wealth Fund members to curate a program of online and offline knowledge sharing and networking activities related to all aspects of their operations, from governance to investment strategies. Victoria has worked in the sovereign wealth fund world for over a decade and has become a noted author and commentator on SWFs. In 2012, she founded the Sovereign Wealth Center, an online provider of data and analysis about SWFs, now part of the Institutional Investors Sovereign Investor Institute. Before joining the International Forum, Victoria was director of Investec Asset Management's Investment Institute, which was responsible for the firm's thought leadership. She started her career as the senior analyst in the office of the chairman of the Monitor Group, a strategy consultancy now part of Deloitte. And she earned her PhD in history from Pembroke College at the University of Cambridge. Please join me in welcoming Victoria here to the table with us. So, as I mentioned, we're going to approach our session today really in the form of a conversation. Adam and Victoria were kind enough to prepare a list of questions. I've got kind of some interpretations and riffs on those questions to ask. I thought it would make sense to begin with a rather general question, which is, of course, both of our speakers on this panel have vast experience in the world of sovereign wealth. So I wonder if you could tell us a bit about what you see as the global picture for sovereign wealth funds. What are some of the major trends that you perceive today? And based on what you have perceived over the last day, or really several days of conversation, where do you see these Brazilian funds fitting in? And perhaps we can begin with Victoria.
Thanks, Paul. Yeah. So when Adam and I started out looking at sovereign wealth funds in sort of 2007, 2008, sovereign wealth funds were very much savings or stabilization funds that had been large pools of money that had been either generated by oil royalties or trade surpluses. And there were these big pools of money that were used to invest in international markets, either for a stabilization fund in liquid assets like international fixed income, US treasuries, etc. Or in the case of some of the bigger funds, they were looking at more advanced strategies in equities and private markets. Over the last kind of 15 years, what we've really seen is a real change in that world and a real expansion. So I'm going to just mention a couple of themes. The first is that from the kind of end of the global financial crisis, we've seen a real growth in the number of sovereign wealth funds being formed. So there are many more now than the IFSWF's 26 original founding members. We now have 46 members. And that represents just about half of global sovereign wealth funds, as against there were about probably 30 in 2008 when we were formed. And these sovereign wealth funds aren't all this kind of classic savings fund, oil fund kind of model. In fact, actually, I think we're only about half our members are now that kind of sovereign fund. Increasingly, what we're seeing is a lot of countries from from across the kind of developmental scale. So we've had a lot of sovereign wealth funds being formed in Africa, for example, but not necessarily from oil or commodity revenues, as you might expect. And increasingly, these funds are a smaller scale. So a lot of our members have assets of maybe under $1 billion or around about $1 billion US. And these funds are really looking at investing what money they have from the state or assets they are given from the state to invest at home for either, for domestic development, so looking at strategic projects, potentially, really funding social programs, making sure that government spending is kind of enhanced in social programs, in education, in infrastructure, and sometimes they're actually, supporting local companies, looking at strategic sectors. So whether that is, as I said, infrastructure or supporting small and medium-sized enterprises, we've seen a real development in that kind of domestic agenda for sovereign wealth funds. So I think that the kind of the expansion of the universe, but also in terms of number, but also in terms of remit and mandate and how they're structured on the governance side. Increasingly, we're seeing sovereign wealth funds being structured, particularly those domestic focused ones that are doing strategic projects, as domestic companies rather than as a more traditional type of fund. And that's really driven by local circumstances. And I think that what's been really interesting this week is so someone who kind of sits in the world of sovereign wealth funds, looking at them internationally, and I understand my members and I speak to them every day, and then you kind of come to a new world where there's a different set of sovereign wealth funds that you don't know. And I forget that I say it, and this has really helped me remember that it has a meaning, is that every sovereign wealth fund is unique and every circumstance is different. And while there are general principles and practices and best practice that we can pick up, whether that's through the Santiago principles or from learning from peers globally, actually it's not about following a cookie cutter approach. It's really about kind of taking the principles of what you're trying to achieve and applying them to the domestic politics, what you need to do with the money. And I think that's been, for me, a really exciting thing to learn this week. And it reminds me that I shouldn't get complacent about that I know all about sovereign wealth funds, because you always have to keep learning. So I'll leave it there.
Thank you so much. Adam, I wonder, I mean, your perspective is, of course, a bit more academic. Do you agree with these trends that Victoria has identified?
Yeah, so firstly, just to say that I'm very excited to be here back in Rio. I was here 18 years ago and for a couple months, and I loved it. And I think Brazilians are some of the nicest people in the world. So it's really great to be here and to go to Samba, which we're going to do again tonight. But back to being serious. So yes, everything that Victoria said is correct. What I'd like to do is, though, as an academic who gets paid to think and work as an academic, put it in a slightly different context, or think about, like, why are we seeing so many sovereign wealth funds now, right? The growth of sovereign funds has really been just in the last 2 decades. Yes, before 2000, we had some very large oil funds. So in Kuwait, investment board was set up in London in 1953. It's now the KIA, the Kuwait Investment Authority. You had the likes of Singapore setting up funds in the 70s, and then Norway set up its oil fund in the 90s. But the massive growth in sovereign wealth funds has really come in the last 2 decades. It begs the question of why. And what's fascinating about it is that if you think about the world and the international political economy, but also the domestic political economy in places like Brazil in the 80s and 90s, what was that? It was a period of privatization, of neoliberalization, where the state had to be put to the sideline. Now, obviously, Brazil hasn't privatized everything as much as Western European countries did. You still have large development banks and state-owned enterprises like Petrobras, but neoliberalism was very strong and still is here. And you could say that, you know, from the global perspective, that was the leading kind of frame for how states should act. States shouldn't be direct actors in capital markets. They should be on the sidelines providing regulation, rule of law, but capital markets and investment should be the preserve of private actors. Now that's changed significantly. We see, as Victoria mentioned, sovereign wealth funds, some very large, many very small, from across the income spectrum, from very rich countries to very poor countries, with all kinds of different mandates. But many of the new ones are being set up to invest directly in domestic markets to foster industrial policy. Industrial policy, which was a word that went out of fashion 2 decades ago and now has been rekindled, and we could actually use industrial policy, and you know, even the likes of the World Bank and the IMF are accepting industrial policy as being something that is a necessary part of what states do. And so what's fascinating is that we see so many sovereign funds, but it's a reflection of, at the same time, the re-emergence of the state as an economic actor. But don't be confused with that as meaning a re-emergence of the state as you would see in the 1950s, right? A very direct kind of top-down state. The types of organizations that we're seeing, both in terms of sovereign wealth funds, but also state-owned enterprises, is that these are operating in the same fashion as a private sector entity. They are often staffed with professional asset managers, no different than any private sector entity. And so what you see, in effect, is the state adopting the practices that you find in the private sector. And we see, if to use an academic term, the financialization of state action and state activity. And here in Brazil, though, just listening over the last few days in the conversations that I've had with people, is that the new funds here haven't quite adopted this, let's say, financialized model of the management of these funds. And then hopefully we'll have some more conversations about that, because it's a slightly separate model than many of the other funds that we see across the world, which are if you like, capitalized, they're focused on investing in capital markets, or they invest in domestic markets in a manner that you would expect from a private equity or a venture capital fund. And here in Brazil, it seems that the funds have not quite moved outside of the traditional realms of fiscal policy and treasury management. And that's perhaps a good thing, but it's a question I think that we should discuss further.
Well, I mean, along those lines, actually, I'm curious to ask, maybe this is an excessive kind of provocation, but in pointing to this trend kind of toward and also away from financialization, I mean, do you see that as kind of an implicit critique, your use of that term?
So, again, I know here in Brazil there is an academic tradition of looking at understanding financialization. Some quite good work that's being done. Now, it depends on how you approach it, right? So there's a lot of critical work about financialization as effectively. The problem is that the political economy question is that, do we want our economies to be driven by the expectations of financial markets and financial performance? Do we want to financialize social policies? Do we want the state to be acting like a private sector entity? And in some cases, you could argue that it's good, right? But in other cases, it's not, right? And I think that's where the discussion on what the mandate of these funds is and how they operate needs to be decided. Because there's many cases where you could argue that it's a good idea for the state to have some kind of a strategic investment fund that, let's say, for example, that the National Development Bank or a local development bank is not doing a good job, then you can set up a new institution that acts like a private sector entity to address market failures, to catalyze new industries, to help kind of reform the private sector to get them to do a better job. So there's arguments for doing that, particularly in very low income or middle income countries where there's the institutional setting and financial sector development is poorly developed. But then often you have to ask in a place like Brazil is that, there's a sufficient amount of banks and investors that why aren't they doing it, right? And maybe it's not that the state needs to act like them, but change regulation, change policy. Now, that model is possible. Then there's also the model of if you want to save over time. If you want to save over time, how do you get the best return, and how do you protect that wealth over time that you could then use for other social policies or other economic policies? And if you want to save over over generations, then maybe it is advisable to invest in capital markets. But the risk is, and Victoria can also speak to this, is that if you're going to set up a, let's say, financialized entity, then it needs to have the human resources to execute the particular strategy, whether it's doing private equity deals or it's managing assets in a different range of capital market securities and different asset classes, both domestically and globally. And that requires human resources, but it requires a governance structure that allows that to happen in a not only legitimate, but an effective and transparent manner. So these are, again, going back to the earlier point I made, is that understanding what the goals are and what the mandate is incredibly important, and then designing the institutions and the organizations around those mandates and those goals is important. So one final point is that I always say that for me, it's the sovereign fund solution or the kind of financialized solution shouldn't be the first point of that a state or a municipality should look at. There's very good public policies that we know work and that are democratically legitimate that should be tried first before setting up these, grand strategies that, let's set up our Goldman Sachs or let's set up this type of investment firm to do this, when actually there's really good public policies that we can have that we know will work.
Can I just jump in there? So I think that's really important. And if you look at, I think there's a couple of things that we think about when, there's this concept of sovereign wealth fund. One, a lot of the funds that you immediately think of have been around for a very long time, and they didn't start that way. They've evolved into what you see the Abu Dhabi Investment Authority doing, or GIC from Singapore. They didn't pop into existence in that way. And even, I'll take the China Investment Corporation is a good example. It was formed out of central, it was a very complicated way of doing it, but the Chinese government wanted to invest in the Blackstone IPO in 2007, and they needed a vehicle to do that. And it wasn't brought out, and so it's always had this kind of desire to invest abroad. And it doesn't have that kind of, I think, public, it's a fiscal policy tool, it's a diversification of foreign exchange tool. And I think that it's really important also to realize that a lot of these sovereign wealth funds come from places with much more centralized decision making in their politics. So there's in a lot of them, so if you look at Abu Dhabi in 1974 when they set up their, it was the British government set it up because there was all this oil money, that they had a population of 200,000 people and billions of dollars coming in. And it was just a decision made by the powers that be. And I think today, in a country like Brazil, that's not the way that they work. There's a much broader conversation. There is a much wider range of needs. And I talk to a lot of my African members about this, which is, what is the best way to invest for future generations? We talk a lot about intergenerational funds, right? And I often say that, these countries, and Brazil is one of them, they're not Abu Dhabi in 1974. They are big populous countries with lots of development need. Is actually the best way to invest in your future generations? Is it really to squirrel money away and have a big pot of money and say we're really rich, look, we're on the top table, we've got this cash? Or is it to spend on education, on infrastructure that's going to create jobs, that is going to really help the future generations of your country? And I think that there is a challenge where public spending is not efficient. That, as Adam said, that you may need a strategic fund to do that stuff directly. You may, and they would be a partner and try, and a lot of these funds want to attract FDI, so foreign direct investment in, and partner with the private sector. But where public spending does work and you have a lot of money, there's, Adam and I have talked a lot this week about the Chilean model, the Economic Social Stabilization Fund, where they have a large sovereign wealth fund that the copper royalties go into. And that money, when it's needed, is then spent. So during the global financial crisis in 2008-9, and during the pandemic, what they were able to do was maintain government spending using that fund. And you get a lot of headlines, and this is, about, oh my goodness, they're spending their sovereign wealth fund. And my point is that's what it's for. You save this money so that you can use it. And I think there's another point that's related to that, which is, if you have a large amount of oil royalties, you can't spend them all at once. You can't just try and push them into the economy. Otherwise, you're going to end up with a lot of white elephants and a lot of wasted money. And quite honestly, the private sector sees you coming, and so I think that there is an important point about, if you do have a lot of money, do you use that as kind of a holding pen to funnel, money into the economy up to the absorption capacity? And that's a kind of big, it's an established economic term, but I think that's really important, of thinking about the sovereign wealth fund is not in a means to itself. It's not, having a sovereign wealth fund is not a means to itself. It is a way of, in a country like Brazil, it is a way of, it's an economic policy tool to really drive development. Okay.
So one point that I wanted to add, so I think, again, the Chilean model, which is very close to Brazil, is a model that should be considered or looked at in terms of their experience. Often when countries in the global south in particular that want to set up a sovereign fund, the model that they look at and the country that they always look at is Norway. They see Norway as having 1.2 or $3 trillion for a population of 5 million. And they think, wow, if we have a sovereign wealth fund like Norway, we're going to be rich. And as I often say and have done for many, many years when I speak with countries that are thinking about setting up a sovereign fund, as I say, you have to remember that Norway was rich before it became incredibly rich, right? So Norway was an advanced Western European welfare state with very high taxes, very egalitarian. They publish everyone's tax and wages every year, so you know how much your neighbor is making. But they were wealthy before they became incredibly wealthy at having their sovereign fund. So the point being is that looking at Norway and how Norway manages its oil wealth is not necessarily the most appropriate for, I would say, most countries, and most countries that still have the ambition to and the need to lift tens of thousands of hundreds of thousands of people out of poverty. And so for a country like Brazil, but even for, I would say, most advanced economies, and that's why you see most advanced democracies not having sovereign funds, is that they have social needs that trump saving for future generations. And that's why the Chilean model is better, because it's focused on stabilizing copper revenues over a 10-year period so that the government has a stability in terms of how much it can spend, but it is focused on, you know, spending and investing in today's population. And so that's why it's really important to not always look to Norway as being this incredibly amazing model, because, again, they were rich before they became rich. It's great to be Norwegian, right? If you have, you know, citizenship and you're not worried about it. But even in the case of Norway, and I'll stop, is that Norway's economy is still very dependent on oil and gas, and we're going to go through an energy transition at some point, hopefully fast. And Norway's economy is insufficiently diversified, particularly if you compare it to places like Sweden. You know, Sweden is not energy dependent. But Norway is still much the economies are focused on natural resource production, and that's a problem. Now, they can draw down the sovereign fund over years, so the Norwegians will be fine. But in terms of economic activity, it's still very narrow economy.
Well, speaking of dependence on oil, I wonder, Victoria, do you see any clear examples of funds that have done an exceptional job diversifying away from kind of one key commodity, like in the case of kind of Norwegian oil? I mean, are there exemplary funds that it makes sense to cite?
So I think if you're looking at a fund where they have used oil revenues to they have specifically used oil revenues to diversify. I think one of the Abu Dhabi funds, Moderator, has done a really good job. So that fund started off as, its roots are in a gas pipeline between Qatar and Abu Dhabi in Dolphin Energy. And what they've done is that it was formed in 2002, but particularly after the financial crisis, the government favoured putting money into Moderator, and they've built, in that kind of late 2000s, early 2010s period, they built hospitals, they built aviation industries. They've really worked. Masdar, they have a huge renewable energy arm. They've built all sorts of satellites. It's a huge diversified fund, and that government made the decision to channel oil revenues after 2008, particularly after 2008-9, but before that as well, into diversifying the Abu Dhabi economy. And I think that what's now happened is that they've come to a point where they built those industries and they're now privatizing them, and they're now becoming more of a kind of traditional sovereign wealth fund. They still have, their petroleum arm, they still have a share, but they sold a share of Masdar. They've really kind of come through that cycle. And I think that Abu Dhabi generally has a lot of different, if you go and look at Abu Dhabi state investors, there are lots of them. And the government has used that oil money across a whole range of different, domestic companies and state-owned companies. But really, they've done a really good job of generating non-oil economic activity. And I think to a degree, that's one of the best models. If you were saying, are you going to use your oil revenues to diversify your economy, specifically? But I think also, that's not necessarily the only way of doing things. Again, I go back to the Chilean model. If you already have good, accountable public spending models, having a sovereign wealth fund that can help fund that and smooth the government revenues, that's, especially in a country like Brazil where you have a vibrant democracy, that's always going to be seen as more legitimate to a degree. Because it's one thing with working about sovereign wealth funds, particularly working with the media, is the great degree of skepticism about sovereign wealth funds and that, is it just the government squandering public money? And I say to sovereign wealth funds all the time, my job title is Director of Strategy and Communications, and that was always a kind of, communications was always kind of one of these ancillary things we kind of talk to people about what we do, but, and actually it's becoming much, much more important, particularly in a democratic country, to talk to your citizens about, be really open and very, about how you're using the money, what it's there for, and explaining it. And we used to have this model that sovereign wealth funds 10 years ago would put their audited accounts online and say, look how transparent we are. We publish our audited accounts. Well, how great. And actually, the problem with that is, unless you are a chartered accountant, you can't read a set of accounts, and your average person on the street doesn't know what that means. And so there is a whole range of communications that will encourage legitimacy, that it's not just about audited accounts. It's about explaining in a accessible way to your citizens and the people that you're spending the money for, about how you're doing it and what you're doing it for. And I think that's becoming, as the sovereign wealth fund world has expanded into more democratic countries, this has become so much more important. And I think that but the challenge then, and Adam and I have been talking about this week, is you have to be very clear about what you're doing. I was at an event in August with African sovereign wealth funds, and one of the massive takeaways from that event was the government wants the sovereign wealth fund to do everything. It wants it to be the silver bullet to sort out oil dependency, to prevent, inflation. There's a whole lot to do strategic industries, to invest in infrastructure. There's this British vernacular, a laundry list of things they want to do, and these funds can't do everything. And I think it's really important that in the way that you think about this is go, what are one or two things that we can use this money for? Focus on them and really communicate that incredibly clearly, because that is where legitimacy and accountability lies, is in that clear mandate and your ability to do the elevator pitch, right? Being able to explain it very clearly. And I think that's super important with my communications hat on, but I do think that I am seeing that increasingly as being important. And I take an example. So in 2018, I said, let's do a reporting and communications workshop. I got 12 people there, and it was a bit of it was a real challenge to get that many people in to that workshop. We've just had our annual meeting. We had a meeting of our advisory committee, and reputation management and communications and all of this stuff was one of the most important things that we came out of that meeting. And so I think that it's changed over time, but it is really important. And as you are thinking about setting up and fixing mandates, being very clear on the mandate and how you communicate that is really important.
So, if I may ask a follow-up, and perhaps this is a slightly unfair question. In a context where there are so many pressing needs, like here in Brazil, how do you think a fund, like the ones that are gathered here today, can go about identifying those priorities in a democratic fashion?
So, far be it from me to tell a local government what their pressing needs are, but I think it is a real point of being very disciplined and looking at where you think I think there are two things. Do you have a problem with putting money to work, as Adam was saying earlier? Do you need a strategic fund that's going to deal with the fact that money isn't being put to work? Do you need to have the government take a lead and do a strategic fund? That is not a yes or no answer. There are lots of strategic funds, but generally where there aren't existing public bodies that do that, or government spending isn't very effective, or there's corruption, or there's a lot. Or do you say, right, we have an existing policy, spending policy that we think is what people need, and actually what that just needs is more money, and we want to use our fund for that. I think so. It's I think you have to identify those needs yourself. It's not I'm not an expert on every situation, but it's like, where do you think an extra bit more money is going to help solve the problem that you're looking to solve? But you have to identify what the problem is and then decide how to do it. I go back to it, and as I really discovered this week, every sovereign wealth fund is totally unique. We can give you principles, we can help you think things through, but ultimately it is absolutely a unique question. So I can't answer that, but I think it's important that you think about that really systematically. It's a good question, by the way.
Okay. So I think, there's a simple answer if we take democracy seriously, that it's basic needs. Right? Everyone should have access to good housing, good education, good healthcare, that we give young people and older people opportunities. And we, and I say we as humanity, should deliver on that. And thinking about how these sovereign funds can assist in that. Yes, it can be complicated, but it doesn't necessarily have to be. So you can imagine taking these windfall oil revenues that you're receiving now and saying, how do we ensure that we use these to facilitate these basic goals that should be our goals? If they're not your goals, then I think that's the bigger problem, right? But it's a matter of then deciding, okay, how do we want to employ this windfall? We know that oil revenues are volatile. Right now, oil prices are super high, so money is coming in. But this could change very quickly and very rapidly. Commodity markets are very, very, very volatile. We know we are in an energy transition. We'll still require oil and gas for quite a while, but the transition is moving relatively quickly. And again, maybe those revenues they'll be time limited. So you're getting the money now, and you can't spend it all at once. You shouldn't spend it all at once, but then how do we then employ that, right? So that's what finding, do we want to use that to provide for some kind of social policy. So we can take one example that's often thought of as the oldest sovereign wealth fund, though I think definitionally some don't look at it as a sovereign fund, is the Texas Permanent Education Fund, which was started in 1821, if I'm correct, at statehood. And that fund for more than 100 years has been used to finance public education at primary and secondary and tertiary levels in the state of Texas. And it's a very basic savings fund that has this pot of money, and then money from that endowment can be used to finance education. But it's a very simple model, right? It's a very simple one goal or one mandate, savings over time. And in the case of being in the U.S., it's easy for the treasurer of the state of Texas to invest that in U.S. capital markets, and it works, right? So again, I think it's looking at what is possible here in Brazil in terms of managing that savings in a cost-effective and transparent manner, and then modeling how you can utilize those revenues for particular social policies. in the municipalities you're in. But that's a very different model than, say, if you want to employ that money to invest in infrastructure or finance small and medium-sized enterprises. So again, it's about setting out what you can do and sticking to a very simple model, particularly in the beginning. Maybe things will change over time, but simplicity, I think, is very important.
Well, so the word social actually has come up a number of times so far in this conversation. And I think in some ways it dialogues right with this necessity of public legitimation that all of these funds are facing, right? They wish to show social returns in addition to financial returns. And so I wonder, how is it possible? What strategies might a sovereign wealth fund adopt to demonstrate its social impact in addition to financial returns? Perhaps either of you may have thoughts on this.
I'll go. Okay. So there's two things that need to be separated, right? There's the investment function, right? What do you do with this money? Do you invest it in capital markets? Do you park it in the bank? On earning some kind of interest, or the investment function if you want to invest in, say, private equity or infrastructure. That's the investment function as a sovereign fund, as an organization, right? Kind of like a development bank, but we like to think of them as different, and often they are different than development banks, but as a financial institution, right? So there's a financial function. Then you have the policy function, right? And so the policy function is saving for future generations, or stabilizing resource revenues over time that go into the budget, right? So it's those two things. And where do you get social impact from? Now, you can have social impact on the investment side, though I think that's very hard to do. Right now it's, ESG is all the discussion in the financial markets, and investors are worrying about environment, and Victoria can talk about social in terms of sovereign wealth funds, right? What does social mean, right? I mean, some people think social is investing in companies that have good HR policies, human resources policies. Social can also be not investing in companies that use child labor, right? So that's the sort of impact on the financial side. Or there's kind of blended finance, and there's all these things that are in the financial world. Often I think I'm skeptical of many of them, though we should try to make greening finance and making finance more socially aware. I think that's a good thing. But in the case of the policy function, I think that's where here in Brazil, and particularly with your funds, that's where the impact will be felt, and that's where I think the most effective impact will be felt, right? And so it's the impact of providing the municipal government with a revenue stream that is stable, such that the municipal government can provide basic services with even in the times of economic dislocation and volatility, right? That's a good social impact. But the point on both of these is that if you want to do the social on the investment side, which I think in your case is probably you're not there yet, and maybe it would be too kind of, it's not an efficient use of your time at this moment, but it's the social side on the policy function. But in both cases, being very transparent and open about what you're doing and educating the population. So a good model to look at is in New Zealand with the New Zealand Superannuation Fund. They have about 25 billion, and their fund, the goal is to fund the baby boom retirees. Formula One is here. To fund the baby, pension, or the aging society in New Zealand. But they are very, very, very transparent about how they invest, what they invest in, and they almost have an education kind of program for the society to say, this is what we're doing with your money, this is why it's useful, this is the thing. And so I think in anything that you do, you have to be very clear on what it is you're doing and how you're doing it, and that's how you get the legitimacy of the population. But it's also delivering on that social impact. That's how you get it.
Yeah, no, I totally agree with everything you just said. And we actually did some research about this, so thank you for that, this year with our members. And I think, so if you are using your fund to, fund spending, local government spending, I think that social impact is much easier to communicate and describe. And it is because that's an existing policy that you have been elected to execute, and it's so much easier to do. That said, I think there's one interesting thing that came out of our research that there are two ways, and Adam puts it slightly differently to the way that we did it, but it's exactly the same point, which is social is both, you can think about it on the investment side as an input, or you can think of it on the policy side as an output. And older, more sophisticated investors may only think about it as an input. So if you look at GIC from Singapore, they don't really think about the output, the impact of their investments. They just want to make sure that they're managing the risks in the S of ESG, the social aspects, so that they're not open to scandals that they've invested in a company that's investing in child labor or sweatshops or whatever. So I think that's an important thing. And the other thing that I think is really interesting about we didn't make this really explicit because we had other things to discuss, but I think with ESG and this idea of social and accountability being now much more important generally in financial markets, but also I think people generally are much more aware of what are you doing with my money, that the more recently founded funds were much clearer about and had a much broader range of things that they were clear about on their impact than some of the older funds. So my organization was formed in 2008, and really the kind of crux of the matter was that all sovereign wealth funds had to invest on purely financial grounds. So in 2008, environmental, social, and governance weren't financial grounds. They were policy things, and a lot of our members were like, we've been distancing ourselves from these things for 10, 15 years, right? That's what we were meant to do. And now the move towards saying, well, on the investment side, that, these things actually do have a financial impact somewhere along the line, that's been quite a big change. But being formed now, and I think also in this environment where you do need to show more legitimacy, you do need to show accountability, you do have to have an impact for your citizens. I think that's a real benefit because you hard bake it in at the front at the beginning. You're not having to retrofit it, and I think that's a real benefit. So you figure that out now, and you get there. It's much easier than some of the more established older funds are having a much tougher time about ESG integration or social integration. And the other thing I'd just say is that if you take the kind of we finance social spending, what good social practice is changes over time. So what is good practice now was leading and kind of very radical in kind of 2016, and it will continue to evolve. On the investment side, that makes it, on that kind of investment input side, it makes it really, really hard to continue to evolve those things. However, on the output side, on the policy side, that is naturally going to change with your elected officials and their priorities. And that makes it a lot easier to make sure that the way that you spend your money is relevant to people at that moment, rather than, and continues to evolve, rather than being set as a policy in stone, because that's not going to work for anybody, because we change over time. I think, and that's the challenge of the social impact. But I do think, as Adam says, think about it as I don't think that the investment side thing is so relevant right now, but thinking about it as that policy impact output part is really important.
Well, I wonder, I'm thinking, one of our fellows at JFI, Jonathan Kanzani, likes to say that, while there are clear and at this point increasingly kind of consensual ways to measure the E in ESG, right? Environmental, social, and governance factors. Environmental factors, we have, increasingly sophisticated tools. Governance, there's, I think, clear principles. For example, the Santiago principles. But the S, Jonathan likes to say, is whatever is in your heart. I'm thinking actually of an ongoing dialogue with Alexandre Gebara from Espírito Santo, about the importance of finding ways to measure the S. Are there any kind of metrics that you think are especially promising along these lines?
So I would just say that when we did our research, everybody was like, the S metric is really hard and the data isn't there yet. One of our interviewees said, S is where E was in 2016, and it's just really difficult. But that's the kind of bottom line of it. No, there aren't any good ones. But Adam will probably.
Yeah, so I think on the investment side, that's a problem. But again, if we're mostly focused on the policy side, we have all kinds of metrics, right? It's childhood poverty, it's jobs, it's the quality of housing. I mean, you deal with these metrics all the time. So again, I think what's important is not to reinvent the wheel, right? Someone always wants to come up with a new metric and a new kind of scoreboard to do things, but we know that, how many people are in poverty? Are people hungry? Do they have a roof over their head? I mean, how many people are working? I mean, these are very simple things that should be the focus of most policymakers. And we know how to count them. Brazil should have really good statistics, and that should be the focus. There's no need to look for some fancy number. Just focus on the basics.
Well, just to remind the audience, we'd really love to have questions and participation from you all. So I'm going to ask another question, but do be collecting your own, and we'll open up for questions from the audience in just a moment. So I'd love to turn kind of specifically to some of at least what strike me as particularities of the Brazilian context. So coming from abroad, it's really striking, for instance, to note that here the Selic, right, the interbank rate, is extremely high historically, right, and that the accumulated return on the interbank lending rate is, I believe, the highest in the world. I think this could be argued to help to drive concentration in the financial sector, to disincentivize private investment. Additionally, I think the kind of political context where individual public servants are often held accountable for what elsewhere would be understood to be kind of collective decisions creates a really striking kind of risk aversion and a kind of sometimes exaggerated personal accountability on steroids. So I wonder, considering these kind of sort of unusual political and political economic considerations, are there kind of aspects of best practices developed by other funds that may be more or less applicable here, given some of these conditions?
So I think so here in Brazil, it's subnational funds. Now, if we think of places that have subnational funds, the United States has the Alaska Permanent Fund, the state of Wyoming has a fund, North Dakota. And for these funds, they live in the ecosystem of the United States, right? So they have no problem investing in New York capital markets. The financial system works for them. Incidentally, states like Alaska are net recipients of federal tax dollars, right? So even though they like to think of themselves as very free and libertarian, and there's still a lot of money flowing into places like that. So that's why models like the Alaska Permanent Fund, which is good for thinking about savings and whatnot, it's not really a developmental tool. But I think it's, again, not knowing exactly the kind of regulatory framework or environment here in Brazil, but from what I've heard over the last couple of days is that there's a lot of constraints on what municipalities can and can't do with accumulated financial reserves. And it seems that, you know, from the investment function perspective, is there's a lot of limitations that kind of disincentivize setting up a sort of separate entity. But again, maybe that's an opportunity, right, to set up a separate, find a way in the institutional kind of legal framework to set up something different. And that's where, you know, there's been arguments on the establishment of strategic investment funds in emerging market economies, where even though there might be a national development bank or, you know, relatively, you know, an existing kind of private sector banking system, if there are instances where those might not be working, and so governments have set up sort of these islands of excellence, these new institutions to try to break and get around these. Now, I don't know if that would be possible here in Brazil, but that's why I think thinking about what you face now, it's more how do you keep it simple and focus more on the public policy side, the kind of fiscal reserves management side, rather than trying to create some kind of more interesting or more kind of sophisticated financial institution, which again also comes with risks and is costly, right? So if you want to set up something that's more active as an investor, you have to pay for that, and it's to make it work, right? You have to set up an institution, and if you don't do that, you can lose money. So that's why it's always better to keep it simple in the first instance.
Yeah, no, I agree. And I think there's another, on this point, I think it's really important that I've come across times where there's been, you know, there have been countries and states, they've been very keen, they desperately want a sovereign wealth fund. And either the legal framework or the political environment has meant that that's been really difficult. And what they've done is they've compromised on legislation, and they've done what we call in British English a fudge. So they've made a compromise. The legislation around the institution isn't clear. And in the case I'm thinking of particularly, this first came onto my table when the people who do the account said, well, we're the central bank, and we account in IFRS, and the government that own it account in local accounting standards, and they're not the same. And this then leads into it's that basic stuff. And I think it's really important from a governance perspective that, as Adam says, it's much better to work within what you can do and keep it simple than try to be overly ambitious and having to do something that is going to be either really controversial or people aren't going to like, and then the legislation is poor. And as soon as you get that lack of clarity in either the mandate or the governance structure, lawyers can unpick this stuff, and this is bad. So I think it's really important that looking at what you can do and really being very clear that, you will have a very clear legal framework, and you know who owns it, and you know what the mandate is, and you know where the balance sheet sits, and all of this stuff. Do it within what you can do, and don't try and create, as Adam says, don't try and create something because you want a sovereign wealth fund. It's really important that the money is looked after well for future generations. And the other thing I think that it's a related point, but I did want to get it in, is for years, sovereign wealth funds have been good because inflation has been low and interest rates have been low. And if you wanted to make money, you couldn't just park it in US treasuries and sit there like you could do before 2008. That is no longer true. So maybe, actually, if you've got a very high interest rate in local markets and it's keeping up with inflation, maybe you don't need to do anything fancy. Maybe you can just park it and use that money. That's fine. But so I think that this is something that we've really noticed, and sovereign wealth funds are really struggling with, is for years they've gone interest rates lower for longer. How do we diversify? How, we're going to have to take more risk, blah, 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 to get higher returns. And actually now we're having to dial back that risk because interest rates are going up and inflation is high. So I just think that I really echo what Adam said. Focus on the policy and try and work within the frameworks that you have and you can, because if you do have higher local interest rates, you may not have to do anything really fancy with that money.
Well, so we received a question from our kind of virtual audience that actually dialogues really with a question that I've been hoping to pose myself, which is, the funds, here in Brazil are quite new, and I was eager to ask, if there are considerations kind of particular to this stage of capitalization that they're in, that you think it's worth signaling, and to kind of bring the internet question into it. How can we harmonize the short, medium, and long terms given the social urgencies and the demands to diversify the local economy at the same time that we can assure, financial returns?
Yeah, so I think again, it's in the case of Brazil. That's why, to reiterate the point about Norway. Norway was rich before it became rich. For Brazil, again, it's about thinking about how long are these resource revenues going to be here? What are they going to look like? And doing some sorts of scenarios around that. I'm sure that's being done. But saying, okay, how much can we expect? And how much of these revenues can we use sustainably now and over the kind of medium term, right? So how can we make sure that these are investments that are made that have lasting value, right? So an example we can look at is in Botswana, in Southern Africa, which has revenues from diamonds. And the way Botswana, which receives royalties for its diamonds, they have a kind of a model where they utilize these revenues, but the revenues cannot be used for recurrent spending, right? So they can't use the revenues for paying for civil servants' salaries. They can only use the revenues for spending on education and healthcare effectively. And that recurrent spending, that has to be funded through regular taxation. So I think it's about finding that particular model where, yes, you can utilize these revenues now, but you have to be able to show how they're being used for the, let's say, the social impact of it. But you have to know, again, what's the nature of the revenue? Is it going to get higher? Is it going to go lower? And how do we create that stability?
Yeah, and I think particularly in the case of oil revenues, as Adam says, there's a relatively established, you adapt it, but there's a relatively established way of, as Adam says, that's interesting, modeling oil revenues over time. And there's what we call, and this is kind of one of the most important things about oil funds, is your fiscal rules, or your saving and spending rules. So how much can you spend just through the budget now? How much can you save? So for lots of funds, they save, so if you look at Kuwait, 20% of the oil revenues go into their Future Generations Fund, which the government can't catch, and then they have a general reserve fund that they can spend out of. But you have to, that is not, there's no kind of one rule that because Kuwait does 20% of oil revenues goes into our savings fund doesn't mean that that's right here. Kuwait's a very, very, very tiny country. So you may be able to spend more, but having a very clear idea of what is the, understanding what you can spend effectively now, saving or putting that other part away. And then the other end of it is, in what circumstances can you take money out of the fund? So lots of oil funds say that we will give 3% of the revenues of the fund to the government to spend every year. That's kind of that's Norway, that's Timor-Leste, it's a really, kind of established model. But that is, again, there's lots of cleverer people than me who can do the maths that will give you what's right in your circumstances. But I do think it's incredibly important for commodity funds to know how much money goes in under what circumstances and how the money comes out. Because as soon as you don't have that clarity around, particularly about the spending, suddenly politicians can make sure that money is, there's suddenly, there's a crisis and we need to spend that money on something that apparently needs spending on. So I think it's very important that as you go through, if you decide to go down that route, is in what circumstances and how much money goes in, and in what circumstances and how much money comes out. And there's lots of good examples of how that's done. But again, just because Norway or Kuwait or whoever does it that way doesn't mean that it's right. It all has to be completely bespoke to the circumstances.
But that's why I think looking at what Chile does is an interesting model, because so Norway's savings model is effectively, it favors longer term savings rather than spending today. And that makes sense for Norway. Because Norway has a slightly shorter time horizon in terms of the resource revenue, and they already have high taxes and income, so they don't need. They still use a lot of that revenue, but they have high taxes, and so. But the Chilean model again is more where what the government is able to spend of the copper revenues is contingent on the modeling of what they think the price of copper is going to do over the next 10 years. But there's very specific, and they have a balanced budget rule, and they have various kind of fiscal policies that limit how much the government can spend, and also considering the absorptive capacity constraints of these revenues in the short term.
Can I ask, have they done well modeling future copper prices?
So the way that the Chileans do it is they have a panel of experts, of kind of well-known Chilean economists that, again, in the case of copper, which is slightly different from oil, is that, Chile is one of the biggest, producers of copper, right? So they kind of are the Saudi Arabia of copper. So they have a better sense of what the market's doing because they are kind of the market, right? So for them, it's easier to model those prices. Whereas oil is a very different commodity. It's much, it's more volatile. And for Brazil to model, the revenues you're going to get, I think that's quite difficult. But again, I think it's probably better to be conservative on how much you can spend, knowing how volatile it is, and that we are in an energy transition, and there are new technologies that are becoming competitive with oil and gas. We'll still need oil and gas for a long time, but Brazil might not be the most cost-efficient producer, right? Whereas Saudi Arabia and many of the Gulf states, they can produce oil and gas for very, very, very little. The cost of production is very small, whereas a lot of the Brazilian resources, these are deep water, it's expensive, risky endeavors that, figure into the cost of the revenues that you would get.
And just kind of, I think the other thing that's really good about the Chilean model, which we haven't really talked about, but while we're talking about it, is the really good thing about Chile is because it's simple, but it isn't human resource heavy. Their team is really small. I think it's 3 or 4 people, and they're all in the Ministry of Finance. And so because of the way that they do it, not only do they with all the things that we've been talking about, but it's a very accountable low cost model. And if we're looking at going back to our point about accountability and transparency, you're not then spending a lot of money on staff and asset managers that is going to be challenging to justify. So actually I think that's just something I know it's slightly off topic, but I did want to point out that that is another reason to look at the Chilean model as well.
Thank you. Well, I think we have a question from for Fernando. Perhaps we could get a microphone to him, and then we'll take a question from Lena as well.
Well, first of all, thank you very much for the conversation. It was amazing, and for sure, take for us some light for what you do in the future. I would like just to make a comment and maybe a question for you that it's related to the staff thing that Victoria just said. The first comment is that as it's a subnational, we have subnational funds, not a national one. They don't control at all the monetary policy or the fiscal policy or the exchange rate or whatever. I mean, they really need to make manage that research, that it's finite. I mean, it's not a perennial one, in the way that they don't control almost anything around. So for me, that's the comment. The most important thing is how to transform such a revenue that it's just momentaneous and depending on prices that they don't have any control, in something perennial. So you have to address social problems directly, and even you have to dynamize the economy to make that those revenues become a part of the budget of the state. So I mean, it's not just maintaining the fund with returns and etc., but put that revenues inside the budget again. So I mean, that's in my opinion, the biggest challenge that we have. The question about the staff is, as we are subnational, of course, that the bureaucracy and the staff are, I mean, just really few people doing many things. My name is Fernando. I am a researcher of our forum. So that's why my question. How can we help the bureaucracy to develop specific skills to deal with that? I mean, we are in UF, it's the university, so I mean, we can have more time to think and etc. And we really would like to help all that bureaucracy to develop, but in the right sense. I mean, they can be few, but they probably has to have those skills, or even our forum can be that space, that hub, to help to design policies and etc. So I would like to ask, which skills do you think it's more important, and how we can do it in our case, in our specific case?
So on your point about staffing, I think there are a couple of things in this case, as I understand it, and I'm always willing to be corrected, is that I think that there's a couple of things that there is I think the policy side of thinking about what you want to do with it. I think that's probably that you have those skills, you understand what needs doing, as Adam was talking about, what the needs of the municipalities and the states are. I think the challenge and where the skills come in is in the investment piece. And I think it's really important to think about it as it's about understanding financial markets and investment, even if it's very simple. It's, there are no sovereign wealth fund secret sources. You see these courses that are sovereign wealth fund specific. All of my members think of themselves as financial investors first, because they're established and their governments have gone through the conversation we're having now in Brazil, right? That's done, it's been decided, we know that. So they think about themselves as financial services, financial investors. And those are the skills I think that often when we get to this point are lacking. And my advice is, if you need to hire some people, make sure they understand financial markets. Central banking, people with central banking experience is particularly useful, right? So I think sovereign wealth funds don't need any specific sovereign wealth fund training. They just need people who understand policy and people who understand finance. There's nothing, you don't need anything else. So I think that in terms of what skills do you need, I think just making sure that when you get to that point is having someone who understands the investment side. And central banks are often a very, very good source of especially if you're talking about keeping it simple, keeping it within what you know and what you can do. Those central bank experiences are really good, and potentially working with a central bank to find people would be where I would start, honestly. I think that's important. Adam, do you want to take the first one?
So, but going to Fernando's first comment, I mean, this is, I think, a big challenge for the funds here, is that they are subnational, and not simply just subnational at the state level, but they're also at the city level, right? So that's where you have no control over of fiscal or monetary policy here in Brazil, right? So and when you look at models like Chile, it's an integrated natural resource revenue framework at the national level that is integrated into fiscal policy and very much aligned with the monetary policy dynamics of the country. In your case, that's all impossible, right? So that, on the one hand, it limits your ability to shape kind of the conditions around you to work. So you're very limited in terms of what you can work with. But I think then what that requires, and this is why I think the having this forum is excellent, is that you'll have to come together and share experiences, and you'll have to utilize the amazing services of Fernando and his colleagues at the universities to help you think about, okay, what are the economic conditions in Brazil as a country, and Brazil in the global economy, and what are the opportunities that you as a municipality or as a state, in terms of saving these revenues, in terms of some sort of financial policy, but how do you kind of manage these over time? So I think it's that dialogue, and that's why it's really great to see that this initiative is going forward, because that information sharing and that the lessons that others can teach you about what to do, I think is super valuable and will be super valuable going forward. But again, also having a good kind of research component to do that kind of out of the box thinking, or the research that you can't do on a daily basis when you're in the bureaucracy, as it were, in the civil service, doing your daily job, trying to just manage these resources. But how do you think in terms of what do we do in 5 years' time, or how do we set this up?
I'll just add on to that as well, and going back to a question that Paul asked me earlier about using money to diversify the economy. I think it's always at a local level you have a kind of idea of where your economy is what your USP is, where your competitive advantages are. And I think that there's always a case of if you want to use this money directly, is to play to your strengths, kind of pick things that you want to develop, like, as I was saying with Abu Dhabi, going, hey, we're going to do repair and, we're not going to build planes, but we're going to repair them because, hey, we're right in the middle of the world and everybody flies through Abu Dhabi or, the Gulf at some point. And so it's thinking, I think, about if you do want to use it to diversify the economy, what are your competitive advantages? Where can you, if you want to put money into building industry, but I do go back to, having said that, I go back to Adam's point is think about the basic needs first before you start doing that. But I think that there is an opportunity, if you wanted to, and if it was, expedient to do so, to actually think about how can we use it to build industries. So in Africa, for example, a lot of, you see a lot of the funds think about not only building infrastructure, but thinking about actually we need to build healthcare, or actually what we need to do is agri-processing, because we need to add value in our, we ship everything out raw, actually we could create jobs and that kind of thing. But I think start with what Adam said is, right, basic needs met, basic policy needs met, and then you can think about, do we want to, catalyze industries or build certain types of infrastructure, or, however you want to do that. So I think that's another potential angle to think about, but start with the basics.
Excellent. I believe now we have a question from Lena Levinas. If I may just say also, please feel free, anyone in the audience, to pose a question in English or Portuguese. I'd be very happy to translate into English.
Thank you so much for your presentations. I learned a lot. I have a very superficial understanding about wealth funds, sovereign wealth funds. So the more I learn from you, the more questions I have, of course. And so I'd just like to highlight two issues. If we look at Latin American countries, we've been trying to overcome extractivism. And in Latin America, these funds cannot be built on anything else except lithium now, because this is the new commodity that will be emerging soon, or coal, or oil, gas, and also commodities, agricultural commodities, as we know. This is extractivism, okay? So the question is, how can we build a sovereign wealth funds incentivizing, pushing further what is really a big problem for our countries. Because this is the big issue. We have deindustrialized Brazil. It's not only because, you see, we have the 80s debt crisis, etc., and then the opening up of the economy. It's because our integration in global markets is determined by this. And now we have China, and now we have lithium, and in this green transition, it's going to be exactly the same. So I think this is a big, big problem, and because this is a strategic issue, and we don't want to deal with this anymore. And there are lots of activist movements, social movements in Latin America now that thinking about this just transitions, they are trying to challenge this way of doing things. And so I think this is important to address such an issue. So my second point, it's just comments. You mentioned the Chilean sovereign fund. I don't know anything about this fund, but I know a little bit about Chile. So Victoria mentioned good public spending and that they were able to, but look at Chile. Okay, that student debt, huge, one of the highest in the world after the United States, and even and after, because exchange rate not as big as the UK one. But hospitals, all financialized. Look at household debt to income, disposable income ratios, the highest in Latin America. So what happened is that over the last 20 years, 25 years, started bigger, but the Chilean social policies have been highly financialized. So I'm not sure that this fund could reverse the trend, because my point is, if we have to depend on financial markets who dominate the world, and if we want to overcome financialized neoliberalism, we have to find another strategy. Because, you see, in terms of political economy, we need a radical shift. We need a break. Because otherwise, sorry to put it in these terms, but it's so interesting what you have addressed here, and you see, because I think that we are just in the middle of, you see, we have foundations like the Hewlett Foundation, the Ford Foundation. They are discussing how to reimagine capitalism, because they agree that neoliberalism has been extremely destructive, increased inequalities, etc., everything we know, okay, and also contribute to the rise of the far right worldwide, okay? So, what is the world ahead? It has to be, again, supported by big finance. Because look at all those investment funds. I would like to know the relationship between the sovereign debt funds with institutional investors. I suppose there is a huge link, of course. So we are contributing to strengthen the logic of finance. So Victoria mentioned, because we have adopted, you see, the finance logic metrics and instruments. This is what Eva Capello calls the colonization of public policy in general. It has been colonized by finance, but we are doing the same. So the point is, countries like Brazil, where we have a social protection system, and where it's not, I don't know anything about the Abu Dhabi Wealth Fund, but I suppose there is no social protection system in Abu Dhabi. So I understand that they need something to provide protection, basic protection in the future. This is not the case here. Everything is being dismantled by the financial sector. And that's the point. So, you see, Brazil is a highly financialized economy and society today. And so the point is, to what extent, and if I think about the idea of what is going on now with this energy transition, the climate transition, everything, more than ever, because they have liquidity, the financial sector is there to provide the funding for this transition. And of course, they will go to developing countries, for instance, to say, okay, let's improve here like the social impact bonds, improve housing, things like this. But we know how they do this. There is a lot of literature on this already that shows that they come and then they establish that during the implementation of the construction of a hospital, you cannot increase wages, okay? It's so wage control and then social movements control. There is a lot of coercion. So what is the price of having a hospital like this? Because we create these funds and then we're going to hire institutional investors to provide the infrastructure. So I'm not clear that because the problem is to what extent these funds can really contribute to help us overcome the dominance of finance in capitalism today. So I think this is strategic for our developing countries. Thank you.
No, I mean, what you say, I think, is completely, I mean, I understand it. I go to academic conferences, and this is what we talk about, just like that. But, so in the case of Chile, it's very interesting, right? Because it is, you know, the neoliberal poster child of the Chicago School, and we know what we saw over the last few years in Chile, this you know, major, massive social protest. And before that, you know, Chile was always kind of politically stable, and but I think it's possible to separate out the kind of the political economy within the country from how you manage these natural resource revenues, right? So in the case of Chile, you know, having a sound natural resource revenue management of the copper revenues is something that, you know, is important irrespective of the distributional questions within the country, right? So having a sound way of managing your natural resources doesn't mean that you have to have privatized universities, healthcare, everything in Chile, right? I think you can have a more socially productive one like Norway, right? So Norway, again, is very egalitarian, but they have $1 trillion of an oil fund that, if you know, I would agree with you, reinforces financialization of capitalism, right? But the other example in Latin America is Venezuela. You know, the Chavez revolution looked really great for a while, but, you know, and there's other issues with that. But, you know, I remember people saying, you know, in Venezuelans I would talk to, is that, you know, we're so rich in oil, yet we don't have a proper functioning highway from the airport to downtown Caracas. So I think whatever the case is, you have to think about how do you manage those natural resource revenues, even if you are doing it it has to be sound, regardless of the political economy that you want to have, right? If you want to have more social distribution, which I think is good, then, you know, how do you pay for it over time? Because you still, I mean, again, so I think on the one hand, we are still within capitalism and global capitalism, right? I'm trying to think how to give a response for this audience, right? That is not too academic, but in the sense that there's, I think, policy decisions that need to be made that focus on the simplicity and the realities of the volatility of natural resource revenues. And if I would agree, you know, are there aspects that will lead to more financialization? Possibly, but not necessarily, right? So you can think of, do we need to have capitalized pension arrangements, or should we just have pay-as-you-go pensions? We can see across most pension systems they financialized, and what has that got us? But I think I would challenge you on financialization as necessarily assuming that it's the financial sector that is leading to the hollowing out of the state and social services. I think it's too easy to put the agency on Goldman Sachs and the financial sector when actually I think it's democratically elected governments in the West that have deregulated and privatized. And I think it's failure of democracy to elect the right types of people to do it, because it's a broader conversation that I think we could have afterwards.
I'm conscious of our time. I know we're coming up against our limit here, but there is one last question that I am committed to asking Victoria. Of course, we're very lucky to have the Director of Strategy of the International Forum of Sovereign Wealth Funds with us today. And so I'd just love to ask if you might say a bit about some of the benefits offered by the International Forum to its members, and about possible ways for Brazilian funds to engage individually or collectively.
Thanks. General plug. I mean, goodness. So I think the most. We do lots of things, but I'll break it into three. The most important thing and why we were founded was around promoting good governance with sovereign wealth funds. So with the Santiago principles, all our members have to. They are voluntary. We know this, but they have to. They sign our membership agreements and say that they will implement these principles. We do not talk about compliance. It is implementation. And the way that we do that is through a self-assessment process, which is part of the membership process, but we also, it's an ongoing process. So we ask members to do that every 3 years. We read them all, we give you feedback. And I think it's really important to understand that with that is that going back to this point about every sovereign wealth fund being unique, it's mostly about, are you implementing this principle in your context? And we ask you to explain how you do that. And what that does is it provides, I think it's a really good exercise for sovereign wealth funds themselves to understand their own structures and how they work and their own governance, and understand where changes and improvements need to be made. But what they also provide, which I think is going back to the point around accountability, is that they're all published on our website. So anybody in the world can come and have a look and read from you an accurate view of how you are structured and governed. And I think that this is an incredibly important tool. Do people really do that? No, but if people ask you, you have a public, independently verified document that tells you this is how we are structured. So I think that is particularly for new funds, I think that is an enormous benefit. And what we can also do is, as we go through the kind of membership process, we can one of my main roles is introducing, people ask me questions saying, Victoria, we're rethinking about the way we're looking at how the board is structured or who's on the board. And then I can put you into contact with people who might be relevant, because I kind of know, because I've got an understanding of the sovereign fund. So at this stage, I think that is the main benefit that we offer, and that networking of being able to kind of integrate with other sovereign wealth funds around the world and learn from them. That's really important. I mean, we do lots of online and offline events during the year. And we also, the other thing that I think is a large part of my job is what we call representation. So individual sovereign wealth funds can only talk about themselves. What I can do is talk about sovereign wealth funds as a group, and we have a kind of policy that we don't really talk about individual sovereign wealth funds. I tend to talk about them as a group. So, I mean, always welcome to talk about, you just have to email me and we can set up that conversation. That's the easiest way to get in touch. My email address is on our website at the bottom of every press release, so it's there. The other thing I think is that we like collaborating with other institutions. So if we work with, there's a group of sovereign wealth funds called the One Planet Sovereign Wealth Fund Network that looks at how they implement climate change. We work with them very closely, we collaborate with them. So we're always keen to collaborate with other groups so that we can pool knowledge, because I've learned so much this week about Brazil, politics, how you're thinking about these sovereign funds, and it's been fascinating. The whole lot of information I didn't know before. And equally, I think that the the pooled knowledge of our 46 members can be a really powerful tool for you as you go on that journey. So being integrated into that global, either as a group on an informal basis or as associate members or full members, I think just provides you with just so much more access to knowledge that prevents you from going through Google and just finding stuff, right? You know, you can come and ask and we'll put you in touch with the right people. So, and just we can genuinely support you on the journey, hate that word, but on that process to kind of working out what you want to do, how you want to do it, and providing you with the necessary support. So that's the main benefit for this group of institutions.
Well, thank you so very much, Victoria and Adam. I mean, speaking of learning, my goodness, I feel like I have just gotten a semester's worth of material in the last hour and a half. What an incredible pleasure to have you both here addressing our questions and dialoguing over the last several days. I hope you can all join me in thanking our two panelists, and I hope we can continue the conversation.